Picture this. The world's factory floor is grinding to a halt, and nobody's connecting the dots. While everyone's been obsessing over tariffs and trade wars, something far more sinister has been brewing in the heart of China's economy. The numbers just dropped, and they're painting a picture that should terrify anyone who's bought anything manufactured in the last decade. We're talking about China's factories, the engine that powers everything from your smartphone to your sneakers, and they're sputtering like a car running on fumes. But here's what makes this story absolutely critical, what makes it the kind of thing that keeps economists up at night. This isn't just about some factory managers missing their quarterly targets. This is about a domino effect that's been set in motion by China's catastrophic property crisis, a crisis so massive that it's literally sucking the life out of the manufacturing sector that once seemed unstoppable. And the craziest part? Most people have no idea it's even happening. Before we dive deep into this economic rabbit hole, do me a favor. If you want to stay ahead of the curve on stories like this, stories that actually matter to your wallet and your future, smash that subscribe button and hit the bell icon. Trust me, you're going to want to catch every episode of this unfolding economic drama. And if you're already getting that sinking feeling that this affects you more than you think, drop a like on this video. It helps us bring you more of this critical analysis that you won't find anywhere else. So let's start with the headline that broke in January of 2025. China's factory activity in January showed signs of losing momentum, according to an official survey that sent ripples through financial markets worldwide. The Purchasing Managers' Index, or PMI, which is basically the temperature check for manufacturing health, came in at exactly 50.1. Now, you might be thinking, 50.1? That doesn't sound so bad. And technically, you'd be right. Anything above 50 means expansion. But here's the thing. It dropped from 50.5 in December. That might seem like a tiny decline, but in the world of economic indicators, that's like watching a sprinter suddenly start limping mid-race. The National Bureau of Statistics in Beijing released these figures, and they landed like a lead balloon. Why? Because this marks the fourth consecutive month of expansion, sure, but the pace is slowing down. It's like watching a car that's technically still moving forward but losing speed with every passing second. And when you're talking about the second largest economy on the planet, that kind of deceleration doesn't just affect China. It affects everyone. But let's rewind for a second, because to really understand why this matters, we need to talk about what got us here. And that means we need to talk about China's property sector, a sector so bloated, so over-leveraged, so fundamentally broken that it makes the 2008 American housing crisis look like a minor inconvenience. For decades, China's economic model was beautifully simple, almost elegant in its brutality. Build, build, build. Construct apartment blocks and shopping centers and office towers and entire cities. The property sector wasn't just part of the economy. It was the economy, accounting for somewhere between 25 and 30% of China's GDP when you factor in all the related industries. Construction companies, steel manufacturers, cement producers, furniture makers, appliance sellers, the whole ecosystem revolved around this endless cycle of building. Chinese families poured their life savings into property because, frankly, what else were they going to do with their money? The stock market was volatile and often rigged. Bank deposits earned next to nothing. Capital controls made it hard to invest overseas. So property became the de facto investment vehicle for hundreds of millions of people. It wasn't just about having a place to live. It was about building wealth, securing your children's future, having something tangible in a world where everything else felt uncertain. But like all bubbles, this one was built on borrowed time and borrowed money. Developers took on massive debts, confident that prices would keep rising forever. Local governments became addicted to land sales, which funded everything from infrastructure projects to local officials' pet initiatives. Banks handed out loans like candy because, hey, property values only go up, right? Everyone from the top of the Communist Party to the average family buying their first apartment was betting on the same thing, that this gravy train would never stop. Then reality came crashing in. It started with companies like Evergrande, once the world's most valuable real estate developer, drowning in more than $300 billion in debt. $300 billion. That's not a typo. We're talking about a sum so large it's hard to even conceptualize. Then Country Garden, another giant, started wobbling. Then dozens of smaller developers. The dominoes started falling, and suddenly, construction sites across China went silent. Cranes stopped moving. Workers went home. Ghost cities, those eerie monuments to overbuilding, multiplied like mushrooms after rain. The Chinese government tried everything. They cut interest rates. They reduced down payment requirements. They told banks to lend more. They promised to support the sector. But here's the problem. You can't fix a crisis of confidence with policy tweaks. When people lose faith in an asset class, when they start believing that prices might not go up forever, the psychology shifts. And in China, that psychology has shifted dramatically. Property sales have collapsed. In some cities, they're down 60, 70, even 80% from peak levels. Developers who survived are barely surviving, cutting prices, offering incentives, basically doing anything to move inventory. And all those families who invested their life savings? They're watching their wealth evaporate, watching apartments they bought off-plan never get finished, watching their dreams of prosperity turn into nightmares of debt. Now, you might be wondering, what does this have to do with factories? What's the connection between empty apartment blocks and manufacturing output? Everything. Absolutely everything. And this is where the story gets really interesting, really troubling, and really important for anyone who cares about the global economy. See, the property sector in China isn't just about buildings. It's about demand for literally everything. When construction is booming, you need steel. Lots of steel. You need cement by the ton. You need copper for wiring, aluminum for windows, glass for facades, plastics for pipes, timber for frameworks. You need machinery to do the building. You need trucks to transport materials. You need workers who then spend their wages on consumer goods. The property sector is like the sun in China's economic solar system, and everything else orbits around it. When that sector crashes, when construction grinds to a halt, the demand for all those materials vanishes. Steel mills find themselves with no buyers. Cement plants idle their kilns. Copper smelters cut production. And all those factories that make the machinery and equipment used in construction, they're suddenly staring at order books that look like ghost towns. But it gets worse. Much worse. Because the property crisis doesn't just kill demand for construction materials. It kills consumer confidence. Remember all those families who invested in property? They're now scared. Their wealth has taken a hit. They're worried about their jobs because if factories are slowing down, layoffs are coming. So what do? They stop spending. They cut back on discretionary purchases. They save more and consume less. And when the Chinese consumer pulls back, factories that make everything from electronics to clothing to toys suddenly have a problem. This is what economists call a negative feedback loop, and it's absolutely brutal once it gets going. Less construction means less demand for materials. Less demand means factories slow down. Factories slowing down means workers get laid off or see their hours cut. Workers with less money spend less. Less spending means even less demand for factory output. Around and around it goes, each cycle reinforcing the downward spiral. The January PMI numbers are showing us this dynamic in real time. That drop from 50.5 to 50.1. That's not just a statistical blip. That's the manifestation of this crisis spreading from the property sector into the broader manufacturing base. And the really scary part is that this is probably just the beginning. Let's dig into what the PMI actually measures, because understanding this helps us see why these numbers matter so much. The Purchasing Managers Index is based on surveys of executives at manufacturing companies. They're asked about new orders, production levels, employment, supplier deliveries, and inventory levels. When more than 50% of respondents report improvement or expansion, the index goes above 50. When fewer than 50% report improvement, it drops below 50. So a reading of 50.1 means we're barely in expansion territory. We're talking about the thinnest possible margin. It's like a basketball team winning by 1 point in the final second. Sure, technically it's a win, but nobody's celebrating. And the trajectory is what matters here. Moving from 50.5 to 50.1 in just 1 month suggests that momentum is fading fast. Now, Chinese officials and state media have been trying to put a positive spin on this. They point out that the index has been above 50 for 4 straight months, which technically counts as expansion. They highlight specific subsectors that are doing well, like high-tech manufacturing or electric vehicles. They talk about the transition from old economy to new economy, from quantity to quality, from low-end to high-end manufacturing. And sure, there's some truth to all of that. China is indeed trying to move up the value chain, trying to compete in more sophisticated industries. But here's what they're not talking about. They're not talking about the absolute levels of activity, which remain well below pre-pandemic peaks. They're not talking about the price deflation that's squeezing profit margins. They're not talking about the export challenges as Western countries increasingly see China as a strategic competitor rather than just a trade partner. And they're definitely not talking about how the property crisis is creating a drag on growth that policy measures can't seem to overcome. Let's look at some specific industries to understand the scale of what's happening. Take steel, for example. China is the world's largest steel producer by an enormous margin. In 2023, China produced more than 1 billion tons of crude steel. That's more than half of global production. One country, more than half the world's steel. Think about that for a second. But here's the problem. About 60% of China's steel consumption traditionally went to construction and infrastructure. When property development collapses, that demand disappears. Steel mills have been forced to cut production, leading to layoffs and financial losses. Some smaller mills have shut down entirely. The ones that remain open are engaged in brutal price wars, trying to keep market share even as margins evaporate. Export markets help, but they can't absorb anywhere near the excess capacity that's been built up over decades. The same story plays out in cement. China has more cement production capacity than the rest of the world combined. During the boom years, China was producing more cement in 3 years than the United States produced in the entire 20th century. Let that sink in. 3 years versus 100 years. The scale of building was absolutely unprecedented in human history. Now, cement demand has fallen off a cliff. Capacity utilization rates, which measure how much of potential output is actually being used, have plummeted. Companies are losing money on every ton they produce but keep producing anyway because shutting down and restarting kilns is expensive and complicated. It's an industry in crisis, and that crisis is rippling out to everything connected to it. Copper, aluminum, glass, chemicals, machinery, the list goes on and on. Every industry that fed the property boom is now dealing with the property bust. And because these industries employed millions of people and sustained entire regions of the country, the social and political implications are massive. But let's zoom out even further because the factory slowdown isn't just about domestic demand. China's manufacturing sector has always been export-oriented, and those export markets are facing their own challenges. The United States and Europe, China's two largest export destinations, are both dealing with inflation, rising interest rates, and slowing growth. American consumers, who drove global demand for decades, are pulling back. European economies are struggling with energy costs and the aftermath of Russia's invasion of Ukraine. At the same time, there's been a fundamental shift in how Western governments view trade with China. The era of free trade, of assuming that economic integration would lead to political cooperation, that era is over. We're now in an age of strategic competition, of friendshoring and de-risking, of tariffs and export controls. The United States has imposed restrictions on Chinese access to advanced semiconductors and the equipment needed to make them. Europe is investigating Chinese electric vehicles and considering its own protective measures. For Chinese factories, this creates a perfect storm. Domestic demand is weak because of the property crisis. Export demand is softening because of slower growth in key markets. And on top of all that, there's increasing political hostility that threatens to erect new barriers to trade. It's no wonder the PMI is showing signs of weakness. Now, some of you might be thinking, okay, but China's been through tough times before. They'll figure it out. They always do. And there's some validity to that argument. China has shown remarkable resilience over the past few decades. When the Asian financial crisis hit in the late 90s, China weathered it. When the global financial crisis struck in 2008, China launched a massive stimulus program that not only protected its own economy, but arguably saved the world from an even deeper recession. But here's why this time might be different. The 2008 stimulus, which pumped trillions of dollars into infrastructure and property development, is actually part of what created the current crisis. All that building, all that borrowing, all that leverage, it worked in the short term but created massive imbalances that are now unwinding. The debt levels across the economy, in local governments, in corporations, in the property sector, are at historically unprecedented levels. And when you're already maxed out on debt, you can't just borrow more to solve your problems. The Chinese government knows this. They've been talking about deleveraging, about controlling debt risks, about shifting to a more sustainable growth model for years. The problem is that actually doing it, actually accepting slower growth, actually letting zombie companies fail and bad debts be recognized, that's politically difficult and economically painful. So they've been trying to thread the needle, supporting growth enough to prevent a crisis, while also trying to address underlying imbalances. It's an incredibly difficult balancing act, and the January PMI numbers suggest they might not be succeeding. Let's talk about what this means for the rest of the world, because a Chinese slowdown doesn't stay in China. When the world's second-largest economy and its manufacturing powerhouse starts losing steam, everyone feels it. For commodity producers like Australia, Brazil, and various African nations, Chinese demand has been the main driver of prices for everything from iron or to copper to soybeans. If China's buying less, prices fall, and these countries face their own economic challenges. For multinational corporations, China has been both a massive market and a crucial part of their supply chains. A slowdown in China means lower sales revenue and potential disruptions to production networks that span the globe. Apple, Tesla, Nike, every major brand with significant exposure to China is watching these numbers nervously. For consumers worldwide, a Chinese manufacturing slowdown could mean higher prices as production shifts to other countries with higher labor costs, or it could mean shortages if supply chains can't adjust quickly enough. The pandemic gave us a preview of what happens when Chinese factories shut down. Imagine that, but spread out over months or years rather than weeks. For geopolitics, economic weakness in China could make its leadership more aggressive internationally as they seek to rally nationalist sentiment and distract from domestic problems. Or it could make them more cautious, more focused on internal stability than external adventurism. Either way, a China in economic crisis is a wild card that makes an already unstable world even more unpredictable. Let's also consider the human element here, because behind all these statistics and economic indicators are real people facing real consequences. Factory workers seeing their hours cut or losing their jobs entirely. Families who invested everything in property watching their wealth evaporate. Young people graduating into an economy with fewer opportunities than their parents had. Small business owners struggling to stay afloat as consumer spending dries up. China's official unemployment figures are notoriously unreliable, but we know youth unemployment, which briefly exceeded 20% before the government stopped publishing the data, remains a serious problem. When you have millions of educated young people without good job prospects, that's a recipe for social instability. The Chinese government's obsession with stability, with maintaining social harmony, makes sense when you understand how precarious the situation really is. The factory slowdown also intersects with China's demographic challenges. The working-age population has been shrinking since 2012. The one-child policy in effect for decades has created a demographic time bomb. Fewer young workers supporting more elderly retirees, fewer consumers to drive domestic demand, less dynamism and innovation as the population ages. A growing economy can mask demographic problems. A slowing economy amplifies them. Now, Chinese officials aren't sitting idle. They've announced various measures to support the economy. Interest rate cuts, reduced reserve requirements for banks, targeted support for certain industries, programs to help property developers complete unfinished projects. The question is whether any of this is enough. The problem with the property crisis is that it's fundamentally a crisis of confidence and oversupply. You can make borrowing cheaper, but if people don't want to buy apartments because they think prices will fall further, lower interest rates won't help. You can tell banks to lend more, but if developers are already drowning in debt and can't find buyers, more lending just creates more bad loans. You can promise to stabilize the market, but if there are millions of empty apartments and not enough people want to buy them at current prices, promises don't change the fundamental math. Some economists argue that what China really needs is a massive wealth transfer from the state sector to households, essentially putting money directly in people's pockets to boost consumption and help them deal with property losses. But that would require the Communist Party to give up some of its economic control, and there's little indication they're willing to do that. So instead, we get incremental measures that might slow the decline, but probably can't reverse it. The January PMI numbers should be seen in this broader context. They're not just a monthly data point. They're a symptom of deeper structural problems that have been building for years and are now manifesting in weakening factory activity. The connection between the property crisis and manufacturing slowdown is real, it's significant, and it's probably going to get worse before it gets better. Looking ahead, what should we expect? In the short term, more volatility in the data. Some months might show improvement as policy support kicks in or seasonal factors provide a temporary boost. Other months will likely show weakness as the underlying problems reassert themselves. The trend, though, is probably going to be one of gradual deceleration rather than outright collapse. China's economy is enormous and has significant buffers. It's not going to crater overnight. In the medium term, we're probably looking at a Japan-style scenario of slow growth, deflation pressures, and zombie companies kept alive by cheap credit. Not a dramatic crisis, but a long, grinding adjustment as the economy works through its imbalances. This would be profoundly different from the China we've known for the past 40 years, the China of rapid growth and rising living standards. A slow-growth China is a more troubled China, both economically and politically. In the long term, the big question is whether China can successfully transition to a new growth model, one based more on consumption and services and less on investment and manufacturing. This is what economists call the middle-income trap, and escaping it is incredibly difficult. Japan managed it. South Korea managed it. But many other countries got stuck. China's path is complicated by its political system, its demographic challenges, and the sheer scale of its economy. What's certain is that the world we're moving into will look different from the one we've known. The era of China as the unlimited source of cheap manufactured goods, as the engine of global growth, as the place where you could always count on double-digit expansion, that era is ending. We're entering a new phase where China's challenges create challenges for everyone else, where the risks once seemed distant feel increasingly immediate. So when you see those PMI numbers, when you read about Chinese factory activity losing steam, don't just scroll past thinking it's some abstract economic statistic. This is about the unwinding of the greatest property bubble in human history and its impact on the factory floor of the world. This is about millions of jobs, trillions of dollars in wealth, and a global economic order that's been in place for decades. This is about your future too, whether you realize it or not. The connection between China's property crisis and its manufacturing slowdown is the story nobody's really talking about, but everyone should be watching. Because when the world's factory loses steam, we all feel the chill. And based on the January numbers, that chill is just getting started. Thanks for watching, everyone. If this opened your eyes to what's really happening in the global economy, make sure you're subscribed so you don't miss the next chapter in this unfolding story. Hit that like button if you found this valuable, and drop a comment letting me know what you think. Are we witnessing the beginning of a new economic era? Is China's slowdown going to drag down the whole world? I want to hear your thoughts. Until next time, stay informed, stay critical, and keep asking the questions others aren't asking.